markets are not just shaped by where prices move, they are shaped by how investors participate. That participation leaves behind signals that helps us understand where market activity is building and how comfortable investors may be with taking risks. One of those signals is turnover. But rising turnover on its own doesn't tell you much. What matters is the direction of the market alongside it. When markets are trending upward and turnover is rising, it signals confidence. Investors are active and comfortable with risk. When markets are falling and turnover is rising, the signal flips. Pessimism is spreading, not contained.
Why do we need to look at other sentiment indicators?
Because this reading, direction combined with turnover, only tells you about a specific segment of the market. If Nifty 50 turnover rises with the market, it tells you something about large cap sentiment. It says nothing about where the rest of the market stands. A contrarian investor asks a different question. Not just whether markets are moving, but where that activity is happening. Is it spread across large, mid and small cap stocks, or is it concentrated in the largest stocks? And more importantly, are investors being selective about what they buy? Or has selectivity started to fade?
Today, we are looking at two more indicators that help us do that. The first is the index turnover, a measure of how broadly trading activity spread across the market relative to just the largest stocks. The second is the quality arbitrage index, an index proprietary to multi-act that tracks whether investors are gravitating towards quality or away from it. Let us start with index turnover. What exactly are we measuring here?
We compare the turnover of the Nifty 500 relative to that of Nifty 50. Turnover in this context is the total value of shares traded in rupee terms, not the number of shares, but the value. The total amount of buying and selling happening within a stock or an index over a given period. We aggregate this on a monthly basis. Nifty 500 covers a broad universe of large, mid and small cap stocks, whereas Nifty 50 represents only 50 largest companies. When we divide Nifty 500 turnover by Nifty 50, this ratio helps us answer one question. Is activity spread across the market, or is it limited to the bigger names?
And how do we read the movement of this ratio?
When the ratio is rising, it can be because the Nifty 500 turnover is increasing, or because Nifty 50's turnover is decreasing, or a possible combination of both. What this tells us is that trading activity is picking up across the broader market. Investors are transacting in mid caps and small caps as well, and not just largest stocks. They are not discriminating by size. The implicit sentiment at this point is smaller companies are worth the bet, the tide is rising and it will lift everything. That is a market where caution has given way to broad optimism, and a contrarian investor watches for when that optimism begins tipping into overconfidence. That is when the risk alarm starts ringing. Once the ratio sustains above a certain threshold, at certain points it is time to be cautious.
And when the ratio falls?
When the ratio falls, it is because the opposite is happening. Nifty 500 turnover is going down while Nifty 50 is going up, or it's a combination of both. Activity is narrowing in the largest stocks. Investors are pulling back from smaller names and seeking the relative safety of established large cap companies. This is typically a more cautious phase. When the ratio falls to historically low levels, that is when a contrarian investor can afford to be aggressive. Aggressive in the sense of adding more risk to the portfolio, because historically this is where the best entry points have emerged.
So when it rises, that's a point of caution for a contrarian investor, and when it falls, that's where opportunity can begin to emerge.
Correct. This is consistent with how we have standardized all the indicators in this series. Up signals optimism in the market, which is a signal of caution for a contrarian investor. Down signals pessimism, which is where opportunity tends to emerge from contrarian perspective. But the direction of the indicator should not be looked at in isolation. Where The ratio stands relative to its own historical average is also important. A slight move up is very different from a ratio that has crossed well above its long-term average. The extremes are where the signal becomes more actionable.
What if overall market activity contracts? If turnover falls everywhere, does the indicator still hold?
It does. If overall activity reduces, both the numerator and the denominator fall. The ratio between them continues to reflect whether activity is distributed or concentrated. You do not need to set this indicator aside in low activity environments. It remains meaningful regardless.
We covered market concentration in the previous episode. How is index turnover different?
Market concentration is based on price. It tracks how much of the index total return is being driven by the largest stocks. Whereas index turnover is activity based. It looks at the volume of trading, the actual buying and selling happening across the market versus within the top stocks alone. A stock's price can be flat while it is being traded. Turnover captures the activity that price alone does not reflect. These two indicators complement each other in a way.
The second indicator today is one that Multi-Act maintains internally. Tell us about the Quality Arbitrage Index.
This begins with a grading framework we apply to companies across our investment universe. When we assess a company, we look at a specific set of factors: returns on capital, profitability and growth, capital structure, corporate governance, minority shareholder interest, and capital allocation. Based on all these factors, we classify them as either high quality or low quality.
And once companies are graded, how is this index constructed?
Each year, from within our graded universe, we create an equal weighted portfolio of the 30 largest high quality stocks and 30 largest low quality stocks. Both the portfolios are reviewed and rebalanced at the end of the year. Simply put, the Quality Arbitrage Index is the low quality portfolio value divided by the high quality portfolio value.
Using this indicator, how can investors understand where they stand in the market cycle?
That is the right question to ask of this indicator. And the logic here again remains the same as what we saw with index turnover. Just as investors gravitate toward large cap stocks for the safety of size during uncertain times, here they gravitate towards high quality companies for the stability. When there is turbulence in the market, high quality acts as an anchor in the portfolio. But when optimism is running high, quality stops mattering to most investors. High quality companies are stable. They are not going to deliver the kind of rapid returns that low quality companies can generate when markets are rising. So investors reach for low quality stocks instead of high quality ones in pursuit of growth during such times.
So the ratio captures that shift in preference.
Exactly. When the ratio rises, the low quality numerator going up means low quality stocks are reporting better returns than high quality ones. The market sentiment at this point is, it does not matter if a company is low quality, it will work anyway. That is what shows up in the highlighted zone on the chart. From a contrarian investor's perspective, that is when you need to be cautious. When the ratio falls, high quality is doing better, which means investors have become very cautious of quality. Everyone is seeking stability. When the ratio reaches a certain level, the contrarian investor can think of adding risk to their portfolio if required.
I want to make one thing clear for the viewers. This is a sentiment indicator. It does not tell investors whether to own high quality or low quality stocks.
That's an important point and one we want to be explicit about. The Quality Arbitrage Index is a sentiment indicator. It tells you where the market is in the quality cycle, which end of the spectrum the crowd is currently favoring. And the purpose of reading it is to objectively assess those market trends without predisposed biases. Different investors have different mandates. Some invest toward the more conservative end of the quality spectrum, some toward the more aggressive end, and some hold a blend across both. This indicator is not a reflection of those choices. Mandates are not always opportunity driven, they are often principle or rule based. What the indicator does is tell you where the pendulum is. And regardless of what that strategy is, you use that information to calibrate. If your mandate focuses on companies at the more aggressive end of the quality spectrum and the indicator signals a risk on environment, fine, that is your space. But even within that segment, there is a spectrum. Use the signal to move toward the stronger end of that spectrum. The idea is to understand the market and to think critically while designing your portfolio. It is about how you read the cycle, and this applies to every indicator in this series, not just this one.
So across both indicators today, index turnover and the quality arbitrage index, we are reading the same underlying question: where is market activity happening, broadly or in the largest names, and is quality being sought or it has stopped mattering? When index turnover and the quality arbitrage index point the same way, the signal is at its strongest.
That is the thread running through the entire series. No single indicator is sufficient. What matters is the weight of evidence that the full range of indicators taken together is telling us. When index turnover is elevated and quality arbitrage index confirms that quality has stopped mattering, both indicators are telling the same story. Participation is wide, risk is being ignored, and sentiment has run ahead of reality. That is when a contrarian investor exercises the most caution. When index turnover and the quality arbitrage index fall together, activity concentrating in the largest name, quality being sought out of caution rather than preference, that convergence often marks where opportunity is building. We are not forecasting, we are reading. We are not trying to call a correction or time a cycle. We are trying to understand where sentiment stands within the cycle, so that decisions are made deliberately rather than reactively. With each indicator in the series, we add another lens to that picture. Together, they form a more complete view of where market stands. Markets move in cycles. Understanding where we stand within those cycles improves decision making over time.